Good morning. As the sun rises over the city, you might be wondering why oil prices are making headlines. Again. It seems like every few months, oil is back in the spotlight, and for good reason. The price of oil isn't just a number on a screen, it's a pulse that runs through the global economy, affecting nearly every aspect of our daily lives. Today, oil prices are dipping, and that's caught the attention of traders, analysts, and everyday people alike. But why does this matter so much? When oil prices move, they send ripples through markets, businesses, and even your own household budget. Oil is a truly global commodity, traded across continents and oceans. Its price is shaped by a complex web of events and decisions, from political moves in Washington and Beijing, to production changes in Texas and Russia, and even to weather events that disrupt shipping lanes. These price shifts have a direct impact on your life. When oil gets cheaper, you might notice lower prices at the gas pump, but it can also mean changes in the cost of groceries, airline tickets, and even the price of goods shipped from overseas. For businesses, oil prices can make or break budgets, influence hiring, and shape investment decisions. Right now, Brent crude is trading at $65 a barrel, while West Texas Intermediate sits at $60. These numbers are more than just statistics, they're signals of what's happening in the world. So, what's driving these prices today? The headline story is the possible end to the historic U.S. government shutdown. This event has had unexpected effects on oil demand, as government operations influence everything from transportation to energy policy. A reopening could mean more fuel use as federal workers return and projects restart. At the same time, there's growing concern about a global oversupply. Oil producers have been pumping out more than the world currently needs, leading to storage tanks filling up and tankers waiting at ports. Too much oil and not enough buyers can push prices down even further. In this chapter, we'll explore how the U.S. government reopening could boost fuel consumption, why major oil-producing countries are flooding the market, and how China's slowing economic growth is reducing demand. We'll also look at the impact of new U.S. sanctions on Russia, which are adding another layer of uncertainty to the market. And there's another twist: the role of the U.S. dollar. Since oil is traded globally in dollars, fluctuations in the currency can make oil more or less expensive for countries around the world, adding yet another factor to this already complex equation. It's a lot to take in, but don't worry, we'll break it all down. By the end of this chapter, you'll understand what's really driving oil prices, how it affects your wallet, and what you can expect in the weeks ahead. So, let's dive in and unravel the story behind today's oil prices. End of scene. Let's start at home. The story of how a government shutdown can ripple through the economy begins in the neighborhoods and cities where everyday Americans live and work. When the federal government grinds to a halt, the effects are felt far beyond the halls of Congress. The 42-day U.S. government shutdown didn't just make headlines, it grounded thousands of flights, slashing jet fuel demand overnight. Airports that are usually bustling with travelers became eerily quiet, and the ripple effect was immediate. With air traffic controllers and TSA agents missing, airports slowed to a crawl, and airlines canceled flights across the country. Passengers faced long delays, and many simply chose not to travel at all, further reducing the need for flights. Fewer planes meant less oil used, sending a chill through the market. Jet fuel consumption plummeted, and the effects were felt by everyone from airline workers to fuel suppliers. Traders worried that this would dent U.S. fuel consumption for weeks, pushing oil prices down. The uncertainty made investors nervous, and the market responded with falling prices and increased volatility. The shutdown's impact went beyond airports. Hundreds of thousands of federal workers without pay cut back on driving and spending, further reducing gasoline demand. Many families postponed trips, skipped outings, and limited their commutes to save money. All these small decisions added up, creating a bearish signal for oil. Gas stations saw fewer customers, and highways that were once busy became noticeably emptier. When a major part of the world's largest economy stalls, its appetite for energy shrinks. Factories slow production, delivery trucks make fewer trips, and the entire supply chain feels the slowdown. That's why oil prices struggled to rise during the shutdown. Refineries processed less crude, storage tanks filled up, and the usual flow of energy slowed to a trickle. It's a clear example of how political gridlock in Washington can ripple through global markets. When government comes to a standstill, the consequences are felt not just in the U.S., but around the world. reminding us that energy demand and economic stability are deeply connected. End of scene. Now for the good news. After weeks of uncertainty and tension, there's finally a sense of relief sweeping across the country. The government has officially reopened, and the ripple effects are being felt everywhere, from Wall Street to Main Street. The Senate has approved a bill to reopen the government, and relief is spreading through the economy and the oil market. Investors and business leaders are breathing a collective sigh of relief as the threat of prolonged disruption has been lifted. The news is sparking positive reactions in financial markets, with traders on the oil market floor responding enthusiastically. As federal workers return, airports will run smoothly again, and flights will resume, quickly boosting jet fuel demand. For days, travelers faced delays and uncertainty. But now, the return of TSA agents and air traffic controllers means airports can operate at full capacity. This is a huge relief for both airlines and passengers, who can now look forward to fewer disruptions and more reliable travel schedules. Airlines are eager to get planes back in the air, restoring a key source of oil consumption. With the skies reopening, airlines are ramping up operations, scheduling more flights, and preparing their fleets for a surge in passenger demand. This uptick in activity is expected to drive a significant increase in jet fuel consumption, which is a major component of overall oil demand. The end of the shutdown also means back pay for workers, more spending, and a rebound in travel and commuting. Hundreds of thousands of federal employees are finally receiving their paychecks, putting more money back into the economy. This extra cash will likely be spent on everything from groceries to travel, giving a much-needed boost to local businesses and public transportation systems. More cars on the road means stronger gasoline demand, the biggest driver of U.S. oil use. As commuters return to their routines, highways are filling up again, and gas stations are seeing more customers. This surge in daily travel is expected to push gasoline consumption higher, reinforcing the vital link between economic activity and energy demand. This reopening acts as a counterweight to negative pressures, giving oil prices a floor. With the government back in action, the risk of further economic slowdown is reduced, helping to stabilize oil prices that had been under pressure from global uncertainties. The market is finding its footing, and analysts are watching closely for signs of sustained recovery. It's a bullish sign. Traders expect demand to rise as the U.S. economy gets back on track. Optimism is returning to trading floors, with many investors betting that the reopening will spark renewed growth in energy consumption. The positive sentiment is reflected in rising stock prices and increased trading volumes across the board. While other challenges remain, the shutdown's end is a major boost for oil demand. Refineries and fuel distributors are ramping up operations to meet the anticipated increase in orders. Ports are seeing more activity as oil tankers arrive and depart, signaling a return to normalcy in the supply chain. The market is stabilizing, and optimism is returning. For now, the reopening marks a turning point, offering hope for a stronger economy and a brighter outlook for the energy sector. End of scene. But there's a big problem on the supply side. OPEC+, led by Saudi Arabia and Russia, has been ramping up oil production all year. The result? A looming global supply glut. When supply outpaces demand, prices fall. That's basic economics. Even with healthy demand, the world may not need all this extra oil. OPEC+ faces a tough choice: keep pumping and accept lower prices, or cut back to support the market. For now, rising inventories and high output are keeping prices down, overshadowing good news like the U.S. government reopening. The fear of oversupply is dominating traders' minds. That's why, despite positive developments, oil prices remain under pressure. End of scene. 11. Now, let's talk about China. For years, China's booming economy fueled global oil demand. But recent data shows China's growth is slowing, and so is its appetite for oil. Less industrial activity and fewer cars on the road mean less fuel needed. This drop in demand from the world's top oil importer adds to the oversupply problem. Analysts are watching China's economy closely. Any slowdown there puts more downward pressure on prices. For oil producers, it's a concern. For consumers, it could mean lower prices at the pump. What happens in Beijing affects wallets worldwide. End of scene. 10. Geopolitics can flip the script in an instant. New U.S. sanctions on Russia's biggest oil producers are starting to bite, threatening to disrupt global supply. Just yesterday, a Russian company declared force majeure in Iraq, a sign the sanctions are having real effects. This raises the risk of a sudden supply shock, even as OPEC Plus pumps more oil. Traders are caught between fears of oversupply and fears of disruption. That's why, despite downward trends, oil prices saw a brief uptick this week. Sanctions on Russia add volatility and keep everyone guessing. Oil prices aren't just about economics, they're about politics and power too. End of scene. One more piece of the puzzle, the US dollar. Oil is priced in dollars worldwide, so when the dollar is strong, oil becomes more expensive for buyers using other currencies. That can dampen global demand and keep prices down. Right now, a strong dollar is acting as a headwind for oil, capping any price gains. The Federal Reserve's interest rate decisions and the health of the US economy all influence the dollar's value, and, indirectly, your gas prices. So, even if supply and demand shift, currency strength can tip the scales. Remember, a stronger dollar usually means lower oil prices. It's a subtle but powerful force in the market. End of scene. Oil prices are a balancing act. On one side, massive global supply, OPEC plus production, China's cooling demand, and a strong US dollar, all pushing prices down. On the other, the US government reopening, which boosts demand, and new sanctions on Russia, which threaten supply. Geopolitical risks add a layer of unpredictability, keeping traders on edge. The result? A tug-of-war between bearish and bullish forces. The market is watching every move. Production cuts, economic data, and political decisions. Oil prices reflect this constant push and pull. That's why they're so volatile, and why they matter to you. End of scene. So what does all this mean for you? Right now, high supply and weak demand are keeping oil prices, and your energy costs, lower. But the market can change fast. A new supply disruption or a rebound in demand could send prices up again. Global events, from China's economy to US sanctions, affect what you pay at the pump. Understanding these trends helps you anticipate changes in your budget. We'll keep watching the key drivers, OPEC Plus decisions, China's growth, and geopolitical risks. For now, enjoy the relief. But remember, in oil, change is the only constant. We'll be here to help you make sense of it all. End of scene.